A lot of income investors love the idea of creating a monthly paycheck in retirement, dependable income that shows up whether the market's up or down. A small group of dividend stocks make that possible by paying investors every single month, sometimes with yields as high as 10 or even 20%. The problem is most of these monthly payers aren't built to last. Of the roughly 80 monthly dividend stocks that exist in the US, most of them are leveraged real estate and financial firms like REITs and BDCs, and many have inconsistent or declining dividends over time. But a few have proven they can do it the right way, paying reliable monthly income backed by strong balance sheets and steady cash flow. Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. In this video, we'll take a look at 3 of those rare monthly dividend stocks that actually earn what they pay. Each one of these companies has raised its dividend annually for more than a decade, maintains an investment-grade credit rating, and keeps a reasonable payout ratio around 70%, meaning they actually earn their dividends with profits. 2 of these stocks yield over 5%, and the third is a touch below, but it has faster dividend growth potential to help make up for the difference. First up is Main Street Capital, ticker MAIN, with a 5.3% dividend yield. Main Street is one of the largest and most popular business development companies. If you're unfamiliar with BDCs, they provide capital to smaller private companies in America that the big banks don't want to touch because they have weaker credit profiles. So Main Street targets companies usually with 10 to 150 million in revenue, and a lot of the loans it makes carry double-digit yields, around 12% on average. Main Street's appealing to these companies because it can serve as a one-stop financing shop. Main Street provides not only debt capital, but also equity capital in many of these businesses it invests in. So instead of working with multiple different lenders and capital providers, a small business can go to Main Street and have that long-term relationship and use that money for everything from management buyouts to recapitalizations, strategic refinancings. Really anything's possible. Main Street's portfolio is very diversified. It has nearly 200 portfolio companies that it's working with currently. The biggest is less than 4% of the portfolio's fair value. The portfolio today is performing well. Investments on non-accrual status are just about 1% of the portfolio's value as well. Main Street's investments are spread out across dozens of different industries. The biggest is machinery at 9% of the portfolio's cost basis. There's everything from software companies, professional services, to electrical equipment, distributors, auto components, tobacco. So Main Street is happy to establish these relationships in lots of different industries. I'll use our website, Simply Safe Dividends, to analyze Main Street's fundamentals. If you'd like to use our website to find dividend stock ideas, analyze your own portfolio, it's free to try. I'll leave a link in the description below. No credit card required or anything like that. Main Street is one of the only BDCs to earn a safe dividend safety score from us, reflecting in part management's great track record of underwriting solid loans that did not get the company into much trouble during the financial crisis or the pandemic. We can see the dividend has been paid safely every year since Main Street went public in 2007 and has been increased most of those years as well, including a 2% bump earlier this month in November. Now, in addition to the regular dividend, Main Street has a pretty good track record of paying these supplemental dividends most quarters going back to 2013, outside of a small stretch during the pandemic. And these really add up. If you take the last 4 quarterly payments and add that to the base dividend, Main Street's yield wouldn't be 5.3%, but it would actually exceed 7%. So it's a very attractive income investment. And that regular base dividend is still nicely covered by earnings. The payout ratio is a little bit below 80%. Even if the Fed dropped rates by another percentage point, we estimate Main Street's payout ratio would stay below 90%, providing it with some margin there to keep the dividend covered during that time. Main Street also maintains low leverage, amongst the lowest leverage you'll find in the BDC space, which earns it a BBB- investment-grade credit rating, which is also going to be the highest you'll find across BDCs. Most either don't have a credit rating or have a junk rating. Now, the one knock against Main Street, and the reason why I sold it from my portfolio at the start of this year, is valuation. So BDCs have been red hot because the Fed's rate hikes the last couple of years have boosted the income in their portfolio, since most of the debt they hold, that they borrow to companies, carries floating rates, while the economy has stayed stable enough to avoid big credit losses. So BDCs have been really hot, and we can see here in this valuation chart that Main Street stock price is still trading a little bit above the expected price band in blue, which reflects where the stock would trade if it was within 10% above or below its 5-year average dividend yield, which has been a pretty good proxy for Main Street's fair value over the last decade. When the market worries about the economy and credit losses, like during the pandemic, that's by far the best time to hold your nose and buy BDCs like Main Street that are quality, that can get through this. Right now, the valuation's not super attractive. I think there will probably be a better pitch in the future if investors do worry about the economy or rates coming down faster than currently expected. If that happens, I think Main Street would become a more interesting monthly dividend stock, but it's certainly one that I would consider buying again for my portfolio at a slightly better price. Up next is Realty Income, ticker symbol O, with a 5.7% dividend yield. Realty Income is a really popular retail REIT that was founded in 1969. It's grown to have more than 15,000 properties today. Nearly 90% of rent is coming from the United States, spread across every region, the remainder in Europe. The company's properties are primarily single-tenant retail. Most of these are triple net lease properties, so the tenant is responsible for paying things like property taxes, insurance, maintenance. That gives Realty Income very reliable and high-margin cash flow. The REIT has also expanded into casinos and data centers over the last 3 or 4 years to give it a bigger addressable market. It serves over 90 industries led by convenience stores and grocery stores, each around 10% of rent. It focuses mostly on e-commerce resistant areas like home improvement stores, restaurants, things that are harder to disrupt online. From a tenant perspective, Realty Income has relationships with over 1,600 clients. The biggest is 7-Eleven at just under 4% of total rent. So Realty Income is very well insulated if any of these tenants falls on hard times like Walgreens. Chances are some other tenants in the portfolio are expanding their footprints and providing opportunities for Realty Income. We give the REIT a dividend safety score of 80 in our safe bucket, reflecting its large size, diversified cash flow stream, and financial conservatism, including an A- credit rating, which is among the highest you'll find in the REIT space. Realty Income has paid safe dividends for over 5 decades. It's increased its dividend every year for 30 consecutive years, growing at about a 3% annualized clip the last 5 years. So not the fastest growth, but when you're starting with a yield close to 6%, it's not a bad combination. Realty Income's dividend coverage is the best it's been in a decade. We can see its payout ratio has come down from about 83% 10 years ago to expected 74% in the year ahead. This is one of the most predictable cash flow businesses out there. We can see its adjusted FFO per share, which is kind of similar to free cash flow for a REIT, has increased like clockwork each year. Even during the pandemic, it ticked up, reflecting the company's quality underwriting with its leases and just the long-term nature of those contractual commitments it has across a very diversified base of tenants. Now, Realty Income is a very bond-like stock. When this research note we published, you have to understand if you're buying something like this that it's very sensitive to interest rates. This chart plots Realty Income's dividend yield in blue and the 10-year Treasury yield in orange. You can see these two metrics have been highly correlated, meaning they move in the same direction together outside of market crashes like the financial crisis here and the pandemic here when Realty Income's dividend yield spiked. When bond yields come down, that pulls Realty Income's dividend yield lower as well. This is a stock that would do well if long-term yields do come in lower in the years ahead. But the opposite is also true. If inflation kicks up, back when Treasury yields were above 6% in the year 2000, Realty Income's dividend yield was actually north of 10%. So if you own this stock, keep in mind that it is very bond-like in how it trades. That's not necessarily a bad thing. Realty Income is better than a bond in my opinion because it gives you a great starting yield and you actually get a little bit of growth each year to help offset inflation. You just have to keep that risk in mind. So I think it's a quality defensive income investment, should remain less volatile than the broader market, and a shift in the interest rate outlook could help the stock as well, but that dividend should remain solid almost no matter what happens. Last but not least is Agree Realty, ticker ADC, with a 4.3% dividend yield. Agree Realty was founded in 1971, just 2 years after Realty Income, but it's only 1/8 the size of Realty Income by sales. It has around 2,600 properties, primarily single-tenant retail. Its sector mix is focused on necessity-based areas like grocery stores, convenience stores, auto parts, a lot of areas that hold up well in recessions. And it works primarily with big national brands like Walmart, Best Buy, Kroger. No tenant exceeds 6% of rent, so a very diversified portfolio, just like with Realty Income. Now, one of the differentiators here for Agree Realty is that 67% of its rent is coming from investment grade rated tenants. This results in a very predictable and secure stream of rental income. And when you compare that to the other retail REITs out there in this chart, you can see that mix is double Realty Income's contribution from investment grade tenants. So a very secure rental stream that Agree Realty has, which supports this overall profile. We give ADC a safe dividend safety score of 70, but its dividend history isn't perfect. The REIT actually cut its dividend in 2011, back when the book retailer Borders filed for bankruptcy and accounted for around 20% of rent. That type of risk is really not a concern today, since the largest tenant is less than 6% of rent, and much of Agree Realty's portfolio is focused on investment grade rated national brands. The dividend coverage is also very healthy. The payout ratio is trending towards 70% in the year ahead, so a pretty good margin of safety there, where the REIT is retaining a decent amount of cash flow for reinvestment. Being smaller in size than Realty Income also has some benefits because growth is easier. We can see Agree Realty's adjusted FFO per share has been compounding at around a mid-single digit pace over the last decade, including 5% growth expected in the year ahead. I think that's enough with that low payout ratio to fuel kind of 4 to 5% type of annual dividend growth going forward. The REIT's valuation looks pretty reasonable as well today, kind of trading near the low end of that expected price band. But this is really just a very financially solid and healthy company, has a triple B plus credit rating, just one notch below Realty Income's, and I would argue a longer runway for growth just given its smaller size. So if you can take a somewhat lower yield of 4.3%, but that's growing probably 2 to 3 times as fast as Realty Income's, I think Agree Realty makes for a pretty interesting dividend growth stock in a retirement-focused portfolio. Main Street Realty and ADC are definitely standout monthly dividend stocks. I put all of the U.S. monthly payers into our portfolio tracker here, and the group as a whole just has a very poor track record of dividend cuts. About half of these stocks have an unsafe or very unsafe dividend safety score. A lot of the others are small or variable payers. So in general, it's not a great idea to be building out a dividend portfolio focused just on monthly payers. You're better off to buy high quality companies that have safe and growing dividends and that can combine to produce a nice solid payout schedule for you. So I hope this video was helpful. It gave you a few new ideas for your portfolio. I really appreciate you watching, and I'll catch you next time.